So during this second session, our finance session, we're going to create a film finance plan from scratch. In this assignment, we will create a finance plan for a film project that includes all the available finance sources that producers have at their disposal today when they put a movie together and finance and produce a film. As a first example, I want to show you a movie that is $10 million, and you would assume, for this example, that one person, one investor, provided the cost to cover the $10 million budget. So this is a movie, in this case, a scenario where one investor basically says, here's a check, just go make your movie. In our assumptions, we are assuming that 35% of the budget will be generated on the take, meaning on the low level, from US distribution rights, which would be $3.5 million in connection with our $10 million movie. We are also assuming, for our project valuation, that the international distribution revenues we can generate with this $10 million movie will be 75% of the budget. 75% of 10 million is 7.5 million. So altogether, we believe that this $10 million movie can generate gross distribution revenues of $11 million. Well, even though the movie looked great on paper because the valuation came out to give us $11 million to cover the budget and the break-even scenario was provided for, we are generating a loss, and here is why. We have to pay the collection agent, which is a neutral agency. You can look at it like an escrow company that collects all the distribution revenues from all over the world, from all the buyers, and will then distribute all the entitlements to the related parties, like the banks, the investors, any profit participants. So in this situation here, we don't have a bank loan, but we have an investor. In any event, the first person that gets paid is the collection agent, and they receive 1% of the distribution revenues registered in the collection agency account. The distribution revenues are $11 million. 1% of $11 million is $110,000 going to the collection agent. The second person that we would get to pay here is the sales agent. The sales agent would charge 15% of, in this case, of all the rights, because they're generating 15% of the gross distribution revenues. 15% of $11 million is $1,650,000. There is no bank loan, so the equity that was given to us, the $10 million, would be paid next. However, there's not enough money there. So there's not enough money for the equity, and there's not enough money to pay them the premium because we are generating an expense component of $11,760,000, but we're only making $11 million. So $760,000 are registered here as a loss in this situation. So in the next example that I'm going to show you, I'm going to take the same movie, but I'm going to take all the revenues that we have, or all the finance sources that we have, and connect them to the revenues we're generating for the same film, and then we'll see if we're now making a profit. When we look at a finance plan that is balanced, we are looking at a movie that would generate about 35% of the budget in pre-sales, would get the 20% down payment from the distributors, would generate 20% of a gap loan. So the senior loan here would be 35% plus tyranny, so about 55% of the budget. And there would be an interest charge, of course, at 12%. We've done this loan scenario before, so you know how this works. And then the bank will also charge a loan fee in our situation here. So for this example, we're going to assume that the bank will charge the loan fee and the interest for 2 years. This is normal. Sometimes banks charge it for 1 year, sometimes banks charge an interest reserve for 2 years. So in our case B scenario, we're going to have a pre-sale loan for 35% of the budget, we're going to have a gap loan for 20% of the budget, and we're going to have interest charged for the 2-year term plus a loan fee. The incentive that we will add here, which would be an incentive loan in connection with production incentives that we have received for the film by shooting in an incentivized region, is 20% of the budget. And because we're giving a loan, we're getting a loan, the lender will charge a 12% fee there as well. We are looking at some deferments that we are concluding here for our film. So 10% of the budgeted line items will be deferred and paid in the waterfall, paid from distribution revenues. And in this case, because someone took a risk in deferring a portion of their fees, they will charge a 10% premium. We will have 5% brand integration in our film, so 5% of sponsorship revenues will be allocated to cover a portion of the budget. The agency that presents us with these sponsorships will charge a 15% fee for them. And then we will pre-sale our music publishing rights for 3% of the budget. So let's take a look what the finance plan would look like in case B. So here's our finance plan for case B. The movie is $10 million. The distribution revenues that we're projecting to be generated are $11 million. The pre-sales that we have generated for this film is 35% of the budget, so that is $3.5 million. The distributors are paying us 20% of that on signing. 20% of $3.5 million is $700,000. That is now the first money that we have generated for this film. The balance of $2.8 million would be the pre-sale loan amount gross. So the pre-sale coming from the bank, the pre-sale loan coming from the bank will be $2.8 million because the bank recognizes that $700,000 were already received as a first installment payment by the distributors. So they're looking at what are the unsold rights. Now, because we have $7.5 million in international distribution revenues projected, because we have $3.5 million pre-sold, we have unsold rights available at $4 million. 50% of that would be what a bank would provide a gap loan for. $2 million will therefore be the gap loan. So altogether, our bank will give us $4.8 million as a loan, and that is the loan amount we have to pay back. Now, what we're receiving from the bank would be the net loan amount because the bank will allocate 2 years worth of interest reserve, 12% per year, making 24%. 24% of 4.8 million is 1,152,000. The bank will also charge a loan fee of 2.5%. 2.5% of 4.8 million is 120,000. So the net loan amount that we will be receiving to cover a portion of our budget is $3,528,000. So let's look at the other finance elements that are available here. We have a production incentive because we're shooting somewhere where we get 20% of what the expenses that we have paid in that region. We will get that back as a rebate from the incentivizing region. Because we're getting a loan in advance and the lender is being paid by the incentive region when we're finishing the movie, we would charge a lender fee of 12%. So the $2 million incentive amount will be subject to a lender fee of 12%, leaving us with $1,760,000 available to cover a portion of our budget. This incentive lender will be paid directly by the incentive, their $2 million. Now, there are certain parties in our production, like the post-production house and the visual effect house, that agreed to defer a portion of their fee that was budgeted in the line item components. So the post-production house agrees to defer 5% of the budget. $500,000 are being deferred into the waterfall to be paid from distribution revenues. The visual effects house does the same. So altogether, $1 million will be deferred out of the budget and will be paid in the waterfall from distribution revenues. Brand integration sponsorships are generated at 5%, that is $500,000, and the advertising agency will deduct 15% of that. We are left with $425,000 from brand integration. And we're pre-selling our music publishing rights for $300,000. Now that we're putting all these finance sources together, we have our equity finance $2,287,000 instead of $10 million. So let's take a look if the movie now makes money that would change the finance sources. So when the $11 million in worldwide revenues come in, the down payment of $700,000 has to be deducted because we already received it. $10,300,000 will then be deposited into our collection account. The collection agent would charge 1% of that, that is $103,000. The senior loan we established earlier was $4.8 million, so we're paying that back now. The sales agent is charging us 15%, that is 15% of the international revenues, and a US agent that we hired to do the US will charge us 5% of the US distribution revenues. And that's kind of a normal range for those things. The Post and Visual Effects House will now get paid their $1 million that they deferred. They will also get paid their premium of 10% of that. And the equity is now being repaid plus the premium. So altogether, all our expenses will come to $10,047,400, leaving us with a profit of $252,600. Not only has our equity been recouped, but we are generating a profit, and the only reason is we changed our finance plan. The waterfall that you would look at when you generate revenues would include the international and US distribution revenues to arrive, and then the following ranking order would occur in regards to repayment. The collection agent would be paid first, the bank loan would be paid next, the distribution fee would be paid third, the junior loan, if there were one, would be paid next, the deferments would be paid in the rank 5, and the equity would be paid in the last rank. So when you have all the distribution revenues come in and you include all the various finance sources we talked about, this would be the ranking order that they would be paid in. And they each have an exclusive ranking position. They're not sharing in that ranking position. But once you hit the profit sharing component, everyone shares at the same time pro rata pro passu in connection with the profit participation that you have agreed with them. Now that you've seen how a finance plan is put together, I would like you to put together your own film finance plan. So would use please case B, the case B that was sent to you via the Excel spreadsheet that I shared. Use the case B and apply the same assumption with the following adjustments. We're going to have the budget be $5 million. The US revenue that the US will pay you for US distribution rights, it's now 40% of the budget, not 35%. The international revenues are projected to be 75% of the budget, and that's what they'll also be generating when you're done and you're going into the waterfall component. And for the US revenues, you're going to have a US agent charging 5%, and we'll deduct that, of course, as an expense. And then you have international revenues handled by an international sales agent, and they will charge you 15% as a fee for all the international revenues that they're generating. You're going to have pre-sales of 35% of the budget, but the bank will only give you a 90% loan on that, not 100% as we did in our example. The pre-sale loans will be discounted by the bank to reflect 90%. And the investor will get a 50% profit share. So I want you to take the profits that will be allocated at the end and give the investor 50% of that. And then the question would be, once the net revenues are generated, the investor gets 50% profits. They will also, of course, get their premium on their money, the 20% on the investment they gave you. Those two elements, profits and premium, would be basically representing the money that the investor made on their investment. So how much would that be? That is the question for this assignment. What is the net revenues and how much does the investor make, including premium and profit share? You can use the Excel that was given to you and that was emailed to you if it's easier for you. You don't have to, but you can. And if you have questions about this assignment, please feel free and email me, and I will do my very best to get back to you as soon as possible.